Good afternoon, Cara. Yes, well, to give a bit of background on this one. So not that long ago, the powers that be at Think Markets told me that I need to do TikTok, right? I need to get out there in social media world and get on some TikToks and do some Instagrams. And in my research in doing that, I came across a bunch of, what would you call them? Finfluencers, I think they're called now, doing analysis on those various platforms. And I can tell you, I was not impressed with most of it, to be honest. It just felt to me that they were rehashing things that they had read somewhere off the internet or read in a few books. And probably the biggest culprit in terms of the indicator most used by these so-called experts and finfluencers was the RSI, the Relative Strength Index. And it's one of the oldest technical analysis indicators out there, but just outside of this social media use, I do find it's one of the least understood and least well used as well. So I thought I'd do some research on that and show viewers a couple of tips and traps, ways to use it and ways not to use it.
All right, well, let's start with the basics then. Tell us what it is.
Yeah, okay, so RSI, Relative Strength Index, we're basically comparing gains in a particular security. It could be really anything, stocks, commodities, indices, Forex, versus losses over a particular look-back period. The traditional method is 14, so 14 periods, which in daily candles is just, well, it's nearly 3 weeks, isn't it? So comparing the gains to the losses, but it's a little bit more than that, because they're just with the maths, there is sort of this echo factor that incorporates the RSI from periods prior to the 14 periods. So it's a little bit complex, but ultimately it's telling you whether the stock has gained more or fallen more over that look-back period, and we use 50 as the balance point. So if it's above 50, we're saying that we're in a bit more of a demand-side market. There's more demand than supply in the market, and if we're below 50, we've got the reverse. As was on screen, we've got the traditional way of using it. So this is what all the Finfluencers were saying. Quite often I heard rhetoric like, a stock is overbought because it's below 30, and therefore you should go out and buy that stock. And then I heard equally, and this is quite common when stocks were doing very well, a stock is now oversold because it's above 70 on the RSI, and therefore you should sell it. A couple of variations on the theme there. I've got, well, some people potentially they were not necessarily selling. Well, I guess I should say what they were doing is, because the stock was oversold, I should say, because the stock was oversold, they were using it to buy. And you can either buy when it goes below 30 or when it crosses back above 30. And then the flip side of that, as said before, if it's oversold, if it's overbought above 70, then you could either sell when it gets above 70 or you could sell when it gets below 70. There's a couple of variations of the theme, but otherwise they're looking to, I guess, go against. This is the crazy part for me, go against the momentum in the market.